Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
President Donald Trump signing an executive order putting his trade deal with Japan into place. The agreement will apply a baseline 15% tariff on nearly all Japanese imports entering the U.S., including automobiles. The government of Japan has also agreed to invest $550 billion in the United States. Joining us now, I'm very pleased to say, is the United States Secretary of Commerce, Howard Lutnick. Mr. Secretary, welcome to the program, sir. I know you wanted to talk about Japan, so let's do that. I want you to share with us the terms of this $550 billion investment fund, a core pillar, of course, of the negotiations that you've been helping to lead with the Japanese. Can you share with us the details this morning, sir?
Sure. So this is a completely different kind of trade deal that anyone's ever seen before. So the idea is the Japanese government will give $550 billion to Donald Trump to invest as the United States and Donald Trump sees fit in America. So the Japanese will get back their money, and 90% of the profits will go to the American citizens, the American taxpayer. So Donald Trump, I'll give you an example. We buy all of our antibiotics, generic antibiotics in China. So Donald Trump can say, let's go build generic pharmaceuticals in America. Let's build those antibiotics in America. The Japanese will fund it, and then we will have generic antibiotics in America. Will no longer be reliant on China. So it's in his hands to invest. This is not ordinary foreign companies investing. This is not Mitsubishi building a plant in America. This is $550 billion by the Japanese government put in the hands of Donald Trump that he can then invest in America. It's amazing. I mean, it's the thing I am most proud of. Maybe it's the most proud I've ever been on a business deal I've ever done.
So it sounds amazing. Do the Japanese think it's amazing? And have they codified this agreement?
They have. So yesterday it was all signed. So the president signed the EO. I signed the MOU with Minister Akazawa in the Commerce Department. This is signed. It is written. So what happens is Donald Trump can select the project that he wants. We put a capital call into the Japanese. They send in the money, and we build the project in America. So if you think about this, $550 billion invested during Donald Trump's term is a ½ point of GDP given to the United States of America's president by the Japanese government. I mean, this is amazing. In order to have a 15% tariff, and so they can keep making their cars in Japan.
Let's just down the details, Mr. Secretary. So the timeline, you talked about the rest of the president's term. Is there a clear timeline here? And what's the enforcement mechanism to make sure it happens?
Well, two things. Number one, they've committed that they will meet the capital call. So when we're building a project, they will fund the project's building during the term. This investment lasts through, meaning they will put out the money through the rest of Donald Trump's term, so January 2029. And let's say halfway through and they've invested $250 billion, they stop saying, I don't want to send you any more money. The tariffs pop right back up, and they no longer receive the cash flow from these projects. It would all just stay with the United States of America. So there is just no way they're going to not fund these projects. And Donald Trump is going to deliver to the American people. And this deal is really, it's just, if you think about it, $550 billion of Japanese government's money in order to buy down their tariff in Donald Trump's hands for his availability to invest and build in America. Alaska pipeline, scale, $50 billion, $100 billion. If Donald Trump wants to unleash the Alaska pipelines, the Japanese will finance it. And it's great for America. It's fantastic.
Mr. Secretary, you'll appreciate we've got a number of topics to get through with you in a short amount of time, so I wanted to turn to other issues and India. This came from the president this morning on social media. It looks like we've lost India, and Russia for that matter, to deepest, darkest China. May they have a long and prosperous future together. This relationship between the US and India has clearly soured. You yourself said earlier this year that India rubbed the US the wrong way. There's an understandable tension that continues to build, but they're not the only ones buying Russian energy. The Chinese are buying Russian energy, and for that matter, the Europeans too. And I think there's a sense from the Indian side, Mr. Secretary, that they feel singled out, perhaps unfairly. What's your comment, your message for them this morning?
Well, remember, before the Russian conflict, the Indians bought less than 2% of their oil from Russia. Less than 2%. And now they're buying 40% of their oil from Russia. What they're doing is, because the oil is sanctioned, it's really, really cheap because the Russians are trying to find people to buy it. And so the Indians have just decided, the heck with it. Let's buy it cheap and make a ton of money. But you know what? That is just plain wrong. It's ridiculous, and they either need to decide which side they want to be on. You know, what's funny is, remember, the Chinese sell. The Chinese, well, we're always willing to talk. The Chinese sell to us. The Indians sell to us. They're not going to be able to sell to each other. We are the consumer of the world. People have to remember, it's our $30 trillion economy that is the consumer of the world. So eventually they all have to come back to the customer, because we all know eventually the customer is always right.
When you are talking with India, Mr. Secretary, I know a lot of companies in the U.S. have shifted manufacturing to India from China, so there's a real interest in this in terms of their costs. How much do you feel like you've lost leverage as a result of the court case that came out fairly recently?
We haven't lost anything with respect to the court case. If you look at the dissent, right, it was 7-4. Read the dissent. The current Chief Justice sided with President Trump. The former Chief Justice sided with President Trump. And the incoming Chief Justice sided with President Trump. And the smartest guy on the bench, which is well known who the smartest guy on the bench is, he sided with Donald Trump. So I think you are going to see the Supreme Court side with Donald Trump, and I don't think we've lost leverage. What we've lost is that India doesn't yet want to open their market, stop buying Russian oil, right? And stop being a part of BRICS, right? They're the vowel between Russia and China. If that's who you want to be, go be it. But either support the dollar, support the United States of America, support your biggest client, who is the American consumer, or I guess you're going to pay a 50% tariff, and let's see how long this lasts.
It seems like there's been a hardening of the line, both with President Trump as well as Modi, and a sense that there isn't really a coming together. In fact, that meeting with Xi Jinping and Vladimir Putin and Prime Minister Modi seemed to indicate a coalescing of the BRICS. Do you see anywhere in the next month, 2 months, any type of deal or backing down to a lower rate with India?
I would expect, like you saw it in Canada, right? The Carney got elected with this term elbows up, meaning let's fight with America. They put on retaliatory tariffs. They were all bravado. And what happened? Their GDP negative 1.6%, unemployment rocketing towards 8%. And what did Carney just do? He just finally dropped his retaliatory tariffs. So I think what happens is, it's all bravado because you think it feels good to fight with the biggest client in the world. But eventually, your businesses are going to say, you've got to stop this and go make your deal with America. So I think, yes, in a month or 2 months, I think India is going to be at the table, and they're going to say they're sorry, and they're going to try to make a deal with Donald Trump, and it will be on Donald Trump's desk how he wants to deal with Modi. And we leave that to him. That's why he's the president.
Speaking of making a deal, I understand the Swiss are in town. Just hearing that the Swiss vice president has turned up in the United States again. Is there a meeting on the agenda for today going into the weekend?
Yes. So I'm going to meet with the Swiss delegation. They're coming in to make a new proposal. And the Trump administration is always willing to listen. But you have to remember, the Swiss like to say they're a small country of only 9 million people, a small, rich country. And how did they become so rich? They sell us pharmaceuticals like it's going out of style, all right? They make so much money off of America. That's why they're rich. So let's hear what they have to say. We'll discuss it with the president. I'm not optimistic, but I'm always willing to listen, and Donald Trump is always willing to listen.
Why are you not optimistic? Traditionally, there's been a decent relationship there in the president's first term, relied on the Swiss a lot when it came to foreign policy and developments in places like Iran. What's happened this time?
Well, if you just consider trade, right? The European Union, right? They open their market, 450 million people, $20 trillion economy, and they say, we'll take our tariffs down to zero. You, the American exporters, can sell us everything. I mean, how fantastic is that? And they say, we'll pay you 15% and you pay us nothing. I mean, that is really, really attractive. Now you go to Switzerland, 9 million people. I mean, what are they going to offer the American exporter as compared to the size and scale by which they export and earn money off of us? So the idea is we need balanced and fair trade, and that's a difficult thing. Now, you saw the Japanese. They decided to take a completely different path. And what they said is we will give Donald Trump the power to invest $550 billion at his direction for the benefit of America. Now, that's a different way of thinking. Now, if the Swiss come out of the box with a whole new way of thinking, I'm open-minded. But if they just say our rich companies are going to buy more of America, I mean, that's what Donald Trump is complaining about.
Yep.
You realize in 1985, America, owned more of the rest of the world. We owned just about 150 billion of the rest of the world. And in 2025, when Donald Trump takes office, the rest of the world owns 26 trillion more of us, because they just use all the money they make off of us to buy us. And sooner or later, they're just going to own us. And Donald Trump has said, enough of this. We are going to own ourselves going forward.
Mr. Secretary, I know you're your own boss on your own time, but your team is telling us we've got to go shortly, so I'm going to squeeze out a few more minutes if I can. At 8:30 Eastern Time, we're meant to get a jobs number. This is what we heard from the BLS just moments ago, that the Bureau of Labor Statistics says it's experiencing a technical problem and data retrieval tools are currently not available on the website. Are we going to see a number in 10 minutes' time?
I don't know if we're going to see a number, but I tell you, it makes it crystal clear. You should have fired the person who was running that group, right? Because if you didn't fire him 2 weeks ago, you sure as heck would be firing him today. So they need new leadership in BLS, that's for sure. They need new tech in BLS, that's for sure. And Donald Trump needs to rely upon the numbers. America needs to rely upon the numbers. You can't have these bent former administration people who have a view and who want to harm the president. We need accurate numbers coming from BLS, and finally we'll have new leadership to deliver it.
Mr. Secretary, you're also going to promise new resources for them to increase their collection and increase some of their staff to go out and make this data accurate.
Yeah, can you imagine they had people calling around? I mean, come on. Computers. Wow, it's 2025 and they have computers. New resources, new technology, wildly better information. That's what America demands. That's what Donald Trump's going to give them. And you just need to change leadership every once in a while and make sure we get it right. I'm excited about what's coming. Of course, you fire the person. What do you learn? You learn that their technology is just, oh boy. But we'll fix it. We'll fix it.
Stay with us. More Bloomberg surveillance coming up after this.
Payrolls report did drop on time 4 minutes ago. 22,000 downside surprise. 75 was the estimate. You're looking at a 3-month average now for payrolls of just 29,000. Captured in the bond market with lower yields, in the FX market with a weaker dollar, in equities. Equities still positive on the session by 0.25% on the S&P 500. The Nasdaq still up nicely by 0.7. The Russell, after a 7% surge in August, up again this morning.
This idea that this could lead to a reignition of the cycle, and it goes back to the question that you asked yesterday. Is this a Fed that will be cutting into something of a reacceleration, or that will cut and spur that reacceleration? And right now, the market, based on the market activity, seems to think that rate cut could be very helpful in allowing the reignition of the cycle.
We've got a fantastic lineup through the next 25 minutes or so. We can kick it off with Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
You've had 5 minutes to go over this. What's your first take?
First take is another weak summer employment report. Immigration seems to be having another impact on the data. When you look at the household survey, the foreign-born population was, again, sort of the weaker part of it. Looking ahead, we expect that you'll have one more piece of negative news. So September 9th, once we get the annual preliminary benchmark revisions, that's going to be revised down to the tune of something like 600,000. So that's going to be another really bad negative headline. Then beyond that, we think that the signs will look a little bit better. So we have another couple weeks of this. It should be a dovish September FOMC, and then beyond that, we think that the tides could turn a little bit, and then you'll start to see the economy start to pick up cyclically. You'll have a bit of a trough, and then the dynamics could look a bit different.
The first thing you went to, though, was population growth. Do you think there's still a big supply side story that's underappreciated in these numbers?
Yes, I do. I think that's a large part of what's going on. Of course, it's hard to sort of decipher month to month, but if you look at the household survey, foreign-born employment was down 342,000, while native-born was up 451,000. The labor force participation rate for foreign-born ticked down again. So it does look like you're seeing some, continued weakness out of the immigration. That helps explain why payroll growth was negative in June. We had 500,000 people from the CHNV program whose visas got expired overnight from May to June.
If that's the case, why aren't we seeing faster wage growth? Why are we seeing the underemployment rate going up? Why are we seeing the average number of hours worked in a week kind of stay stagnant or even go down, right? These are the signs of weakness that people look at on the corners and say, wait a second, there is something here that speaks to the demand side as much as there is this also supply side story.
Yeah, the wages were fine, up 0.3%, which is an okay number, not a number that you would expect if the labor market was really falling apart. So what we're seeing is a combination of supply and demand. It's certainly not just a supply side story. Demand is also softened. But when you look for the months ahead, that demand should start to pick up as the tariff uncertainty starts to fade. So we had a lot of things, largely policy driven, that hit the economy over the summer. That should go the other way later this year. But right now, it's a combination of a supply side shock and also some significant hits to the demand side as well.
Mike McKee standing by. Mike, you've got some more.
Yeah, John, to the issue you're just talking about now, I'm not sure it holds a lot of water because the civilian labor force grew by 436,000 during the month, which is the biggest since April. And April was when the month that we saw the market, the labor data start to weaken. The participation rate actually ticked up. And at this point, it doesn't look like immigration played a big role. I have to mention here that the BLS cautions on its website and in its literature not to use the foreign-born, native-born population statistics to just tell you what happened this month, because there are statistical reasons that they don't. It's complicated. I won't go into it on the air, but I'm not sure that gives us a whole lot of information. It's been a talking point used by administrations from both parties, but I'm not sure that makes a lot of difference. The biggest thing that we saw in the numbers here quickly is that leisure and hospitality and also education and health are the only two categories that really show any growth at all. Education and health, about 46,000. Leisure, hospitality, 28,000. There are an awful lot of categories that lost jobs during the month. I will point out that construction jobs were down by 7,000. ADP had them up by 16,000. And in that strange comment the president made last night about the payroll report, which suggested he already knew what the numbers were, he said it's all construction now, but it doesn't seem to be construction either.
Mike McKee with the latest. Mike, thank you. Stephanie, you were following that explanation. Please, want to give you some time to respond.
Yeah, so I think it's fair. The data are certainly volatile month to month, but if you look at the foreign-born statistics out of the household survey, it's been fairly weak for the past couple of months. So to the extent that, of course, it's not a perfect picture, but we do know that there's significant crackdown from an immigration perspective that is likely having some impact, although it's very difficult to get a clean read out of the data, you saw the foreign-born employment fall 342,000 in August, 416 in July. It's hard to say that there's no impact from an immigration perspective. Of course, it's difficult to get the exact precise numbers out of the household survey because it is notoriously volatile, as Mike just mentioned. Yeah. But it's hard to say that there's no impact from immigration.
Getting a range of responses already this morning. This from Neil Dutta of Renmac. The Hawks have lost on their own terms. Employment growth is still cooling, and the unemployment rate is rising.
You have right now a 100% chance of a rate cut baked in for later this month. So it seems like they are agreeing with his assessment and that on their own terms, this would warrant a rate cut. Key question to me is, what is the depth of the weakness? And I keep going to, yes, the bond market response, but that's actually less interesting to me than the stock market response. Sure. The fact that there is this belief that this is not great, but it's not so bad that it curtails the cyclical tilt that we've seen. And that, to me, is really the big question.
Let's turn to Jeff Rosenberg on that. He joins us from BlackRock. Jeff, welcome to the program, sir. What do we always say? The first move isn't always the right move, and let's see if this sticks, but the first move is stocks higher. What's your take?
Yeah, the first move is stocks higher, and this is bad news is good news for the stock market because the Fed's going to ride to the rescue and cut rates, and the economy's not going to fall off a cliff. Financial conditions will help that. It's a little bit circular, but if the Fed is going to underwrite the risk rally, then financial conditions will hold up confidence, even if you're having a little bit of a slowdown here on the demand side. So, look, that's the initial read. You know, Russell 2000, NASDAQ outperformance is really quite notable. People piling into what has already been working because the Fed is going to be behind that. And I think that, you know, on top of what Stephanie and you all were just talking about, yeah, it's a weaker report, but it's a weaker report that solidifies 25, but it's really about, and I think this is where Lisa was about to go, you know, what's the path from here? Does this put October on the table? Does this put 50 on the table? But what it really puts on the table is a Fed that gets back in motion for cutting rates. And if the economy's not falling off a cliff, that's a pretty good combination for risk assets. And that's why you're seeing, at least in this initial reaction, bad news is good news.
You said something really important there, Jeff, that this is an indication that the Fed is going to underwrite risk assets at a time when there is enough weakness in labor markets to justify that. What gives you confidence that the weakness that we're seeing is fixable or addressable by a couple of rate cuts this year by the Federal Reserve?
Well, I wouldn't overstate that and say that it is, but the confidence piece of that is really the primacy of financial conditions. And so, you know, while we're worried about a lot of things, one of the things we're not worried about is financial conditions, and they are exceptionally easy. And this is what I've said on the program many times. You know, we focus on the economy, and it's this kind of debate. Does the stock market worry about the economy, or does the economy worry about the stock market? And I think it's more the latter, that it's about financial conditions. And the stock market is less about the economy and much more about AI and technology. And that boost to wealth is supporting consumption, and that's what drives the economy much more than anything else. And so I think that's what kind of eases the concern here around the slowing in the jobs market that we're seeing out of today's data.
If we've seen the hawks throw in their hawkish tilt and become more dovish on the Federal Reserve and start cutting rates, does data like this, Jeff, make you think that maybe you have to price in steeper cuts over the remainder of next year, especially with the changing of the guard, that maybe this market is underappreciating the risk of more significant easing?
Yeah, it's a really good question. I think it's one that will turn our attention increasingly towards, which is, okay, to what end? Waller, gave a little hint in that in his interview earlier this week, 100 to 150 basis points. That seems to be what most consensus views around Taylor rule implies. So that amount is kind of priced in. I think the uncertainty that you're alluding to is, will that be enough? Do you end up pricing in, more than that? Right now, the kind of standard economic analysis, the Taylor rules, are arguing for a path of cuts, but it's a shallow path. because policy is only moderately restrictive. And yes, the delta and the change here is to the downside, the deceleration on the demand side. But as Powell's highlighted, this is also still a labor market that is, not tremendously out of balance. These are small increases. Yes, there are increases in the unemployment rate, but the supply side and the demand side are both easing at the same time. And you see it in the strength in the wages, the persistent, the one thing that didn't happen here is a big slowdown in the work week, something we'll keep an eye on. And so that'll hold up. How deep does this path have to get?
It's quite a move at the front end of the curve. Jeff, just to keep you up to speed on things, if you haven't got the Bloomberg in front of you, we're down 9 basis points at the front end of the curve, now trading at 340, 349, so into the 340s now, which is something we haven't seen all year. 10s are at about 4.09%, so we've broken down through 4.1. 30s are way off, away from 5% at the moment at about 481. We're down 4 basis points on the session. So, Jeff, let's talk about the shape of the curve. There is a fear held by some, not all, but some, that we'd see a repeat of last year, that we'd see some weak jobs data, the Fed would come out of the gates aggressively, and what you'd see is the front end come down, but the long end would actually sell off. Yields would rise, and maybe we'd get the same kind of move that we saw last year. Jeff, do you see things lining up for a repeat of 24, or is this different this time?
Well, it's certainly different this time. And, the day's focus is on the labor markets, and it's a premier data point for the growth side of the equation. But next week, other data will come out, and we'll focus again on the other side, which is the inflationary side. And so this is really the tension that you see within the curve, that if the Fed is cutting and they're telling us, and Powell was pretty clear coming out of Jackson Hole, there's a primacy of, within the dual mandate, the growth side, the maximum employment side of that mandate. But it's happening at a time, and this is where the hawks have, kind of been, squawking a little bit, that, hey, the inflation piece hasn't really been solved, and the uncertainty of the pass-through of tariff inflation is still in front of us. Plus all the other things that go into the back end of the curve, the demand supply, the fiscal, the deficits. It raises the potential here, and you're seeing it in the curve this morning, that you just lag the declines from what the Fed is doing in policy rates to the back end of the curve. And that view is, pretty consensus in terms of the expectations of steepening. And we've had a lot of that put into the curve already. So, that may get a little bit tired, and you've got some technical positioning. Everybody's on the same side of the boat, so that can have an unwind. But the fundamentals behind a steepening curve outlook, cutting interest rates in the face of still sticky inflation on top of all the fiscal concerns, do argue that the pass-through from policy in the short end to the back end won't be as strong as we would historically expect, absent, the big shock of an economy that really decelerates and brings back a specter of not inflation, but deflation. That's how you get the back end to really outperform.
Stay with us. More Bloomberg surveillance coming up after this. Michael Nathanson of Moffettnathanson has a buy rating at 230 price target on Alphabet shares and writes the following: this outcome is a home run for the status quo, and the status quo has been very favorable to Google. Michael joins us now for more. Michael, welcome to the program, sir. Just your reflections on what happened earlier this week, and then we can get to whether there are some competitors that can really break up this status quo.
Yeah, good morning, Jonathan. That was the best outcome, obviously, possible. The market had been really fearful of what the courts could have done here, and it could have hurt Apple deeply and Alphabet deeply. And you look at this and say, to your point, the court was smart to say change is coming anyway. Why are we going to accelerate whatever's happening? Let's let the markets decide the future of search. So I was really pleased as a Google bull, Alphabet bull, but I thought it was a really smart decision by the judge to kind of step back and say, this is going to change anyway. Let's see where technology moves us, right?
So, Michael, how do you think it's going to change, and why stay constructive on this name?
Okay, Good question. So what's going to happen is search as we know it has changed already, right? Search is moving from links to answers. If you use OpenAI, ChatGPT, or even the new AI mode on Google, you're seeing a different type of search. That is mostly happening in informational queries, not commercial queries, right? So our view is it's going to take a long time for commercial queries. Find me the best hotel in Boston. Find me, a new dog food for my dog. Those searches are still happening more traditionally. And I think what's going to happen is as less queries, basically more queries will stop at the head end of an AI mode. The queries that remain, questions that remain, will be more valuable for the people who are selling answers, right? Does that make sense to you, Jonathan? So our view is that the price of the traffic to people's websites will only go up because there'll be less traffic going to people's websites as more answers are headed off at people like an OpenAI or AI mode at Google.
So it's consolidating all of the attention on a smaller group of names, so it's a more valuable proposition. Do you think that Google needs to really now ramp up any type of open AI competitor, any kind of chatbot, artificial intelligence-induced search result in the next 2-3 months? They have a time on them, a clock on them, to sort of show their mettle in their competition with OpenAI.
So it's interesting. I would say to you, if you had me on 2 years ago, a year ago, I'd be very nervous about their speed to market and their ability to change. They've been changing the past couple of months pretty aggressively. They had an event called I/O back in May. They launched a bunch of new products. If you look at what's happening in real time at AI mode on Google search, you're seeing tremendous change. So I think the ramping is happening in the current time frame. I am less worried than I was a year ago about their ability to change. I think they've realized our job is to deliver consumer satisfaction. Our job is not to hold on to business models that have been great to us. We need to basically look at what consumers want and give it to them. And if you dig into what Google is now providing, it's really massively changed. So I think you will see in the next 6 months to a year even more change. And it's going to be multimodal. You'll see change when it comes to video search and an image search. They're really moving quickly to create a 360 view of search that's just more than text. So I'm pretty bullish on their product roadmap and what we've seen so far. I think that's the big change, that the market has woken up and said they're not dead, they're not sleeping at the wheel. They see the challenge from ChatGPT and they're taking it on pretty aggressively.
You mentioned Apple and that they also benefited from that. And I wonder, a lot of people waking up to the fact that Apple's not dead as well in the past couple of days, at least by virtue of their share price. Were you comforted by the fact that Tim Cook was at that meeting yesterday and it seemed like the president seemed a lot more amenable to him calling out some of the investments and even giving him a nod with their India presence?
Yeah, so Craig, my partner, covers Apple. We had a sell on Apple heading into the court. The court findings, we're really worried that they would lose $20 billion plus of payments from Alphabet, which was pretty much all profit. Jonathan's point about the status quo remaining is incredibly positive for Apple, that they can work with Google. Maybe they build a new Siri product that's been rumored. They don't have to lose $20 billion plus of payments. And then to your point on this administration, the administration has been very, very positive, and they could have been a lot more aggressive in pushing Apple to move production to more expensive markets. So I think it's a massive win-win for Apple. Tim Cook has played his cards perfectly here. And then he got the benefit of Judge Mehta, allowing him to kind of maintain that relationship with Alphabet. So you had, in a matter of a week, two stocks, Google, Alphabet, and Apple, that were really underweighted by a lot of investors, come back to the forefront. And that's why the market's been so strong. It's been a great outcome for these guys.
Michael, just before you go, do you pay much attention to seating plans and who gets the seat next to the president? Do you read anything between the lines?
Probably. I probably do, right, John? I did not see the seating plans last night. I apologize. I was too busy watching.
Mark Zuckerberg was the first person next to him. I'll give you that cheat sheet.
Thank you so much. Well, look how much Mark Zuckerberg's spending right now out of nowhere in CapEx, right? They've just massively ramped up their investment in the U.S. on data centers, right, in Ohio and Louisiana. Right? So he's spending. He has Dana White on his board now. He's done more than anyone I could think of to get back into the good graces of this administration.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.